Well,
Perfect.
thank you everyone that's on now for joining us for our tax efficiency through multifamily presentation. Excited to have you all here. I know it's a Friday night, so it's definitely great to have you with us on this evening. And hopefully everyone has a few nuggets that they can take away from this to help their family create wealth. A few ground rules before we get started. If you have any questions, please put them in the chat section. The chat button is at the bottom of your screen. And if you send it to the whole group, everyone can see the question. So if someone has the same question, we don't duplicate it. If we don't get to yours or we have any additional questions after the presentation, feel free to email us or give us a call. We'll share our contact information at the end of the presentation. So without further ado, I'll go ahead and get started with a brief background on Pecos Capital. Pecos Capital is a private equity firm focused on investing in value-add B and C multifamily assets. We're currently targeting assets in New Mexico and Texas. We currently have over 15 million in assets under ownership, comprising over 220 doors. And as you can see, all of the pictures in front of you are assets that we currently own. Most of the assets we actually personally own, which has helped us solidify our investment thesis. And we're now looking to raise capital to bring our investors the same outstanding returns that we've received personally through our personal real estate investments. So now we'll briefly introduce ourselves and go over our personal experiences. And then after that, Malai will take you through what 107 days means, what your why is and why it's important, the 3 different types of income according to the IRS, Robert Kiyosaki's cash flow quadrant, and then go into why if you make too much, what you can do to avoid paying the highest level of taxes. And then we'll give a multifamily investment example, and then we'll bring it over to questions. So go ahead, Malai, and give a brief introduction, please.
So this is Malai. I'm one of the managing partners in Pecos Capital. I started the real estate journey in 2004, and I have a portfolio of single-family homes. I do hard money lending and invest in mortgage notes. As far as multifamily, I've been a GP, which is a general partner, and a limited partner. And I have invested in 6 other deals as a LP with over 1,000 doors. I'll turn it over to you, Mike.
Yeah, thanks, Malai. So my name is Mike Prahl. I'm also one of the managing partners in Pecos Capital. I started my real estate journey back in 2012 by investing passively in small multifamily properties and working for a property management company while I was in college. After I graduated with a real estate and finance degree, I then worked in investment and corporate real estate banking for 6 years. While I was there, throughout my banking career, I began investing in real estate actively, picking up a duplex, fourplex, and a condo before I made my jump into commercial apartments. As of the beginning of 2020, I've been a full-time real estate investor and currently have over 200 units under management as a general partner and just under 500 units as a limited partner. And that's about it. Take it off, Malai, or Mahesh, excuse me.
Thanks, Mike. Hello all. Welcome to the webinar. I'm Mahesh Krishnaswamy, one of the managing partners of Pecos Capital. I started my real estate investment back in 2003. As far as multifamily, I have experience in multifamily as a GP. Without further ado, I will pass it back to you, Mike.
Yep, thanks, Mahesh. So a brief disclaimer before we get started. Pecos Capital acts solely as a principal and not any other capacity, unless we explicitly stated or agreed to. The information you're going to see in this webinar, you should consult with your own financial, legal, accounting, and tax advisors as applicable. You'll see a lot of tax examples here, but you should definitely consult your CPA before going forward with any of these different principles we discuss here. So definitely consult a professional advisor, and also remember that laws and regulations change all the time. So make sure that, if you invest in a multifamily deal, you are aware of the latest laws and regulations as they apply. All right, and yeah, go ahead, take it away, Malai. Let us know what 107 days means.
Thanks, guys. So you must be wondering, what is this 107 days, right? That is, believe it or not, you have to work 107 days just to pay taxes. And that's only if you're average, right? So most of you guys in this webinar, you're above average, which means that you have to work more days just to pay taxes. So 107 days is about 22 weeks. And we get excited when we get on a new job or whatever, that if we get 2 or 3 weeks of vacation. So think about 2 or 3 weeks of vacation versus 22 weeks just working for the IRS just to pay taxes. That's the time away from your kids, family, hobby, whatever you're passionate about. That's the 22 weeks right there. So then the question becomes, how do I save on taxes? Well, I'm not here to talk about politics or anything, but let me start off by saying it doesn't matter who is at the top, who is the president, which party is at the top. The taxes are only going to increase because of our social commitments. It's just getting bigger and bigger. So the taxes are just going to increase, and that's just the reality, right? But that doesn't have to be your reality. Let the ignorant people pay more taxes. Even Warren Buffett, I guess, he's one of the biggest proponents of, tax increase. Even he optimizes and just pays what he should pay, right? I mean, not that he just doesn't want to pay more, which makes complete sense. So what can be done, right? So that's the presentation today. So, and I'm sure most of you guys know that I'm very passionate about this topic. And, I have 2 goals for this webinar. One is to inspire you to dig down deep, and which is sort of related to this tax. And the second one is to really open your eyes on what options are out there so you can get an idea of what is there, what's available. So let's get started on a quick inspiration. So I'm not sure if you guys know about Mongolian warriors. I'm sure you must have heard about, Genghis Khan. He is one of the ruthless. He is unbelievably ruthless, and he is one of the best strategists per se. The main reason why they actually didn't lose most of the wars is not because of their strategy or their ruthlessness or whatever. It's because of their why. And their why is anytime they go to war, they take everything they had, their wife, kids, family, everything, possession, herd, cat, dog, everything, whatever they had, they took it to the war. So their why becomes so big that they have to win the war, right? So that's why they actually win most of the war. The bigger the why, the how gets easier. So make your why. If you want to achieve something, make your why bigger so you're attracted to the goal. Now, so let's just talk about our why here. Our why here is we actually want to save on taxes, right? I mean, so why do you want to save on taxes, right? Why do you want to invest? I guess, why do you even want to make money? This just sounds like a stupid question, but it's not as simple as it sounds. It has a much deeper meaning to it. All of you guys in the webinar, or anybody who's going to be watching later in LinkedIn, YouTube, or Facebook, if you stop working right now, like this day, if you stop working, I'm positive that most of you guys can support your family with food and shelter for the rest of your life, right? So what does that mean? I mean, of course, you might not have the same lifestyle. You might have to move to a different place or whatever, but you will be able to support your family for the rest of your life without working. So that means that you're looking for something more in Maslow's hierarchy, more than basic need, right? Some fulfillment, some satisfaction. So how do you get that? Is it time or is it money? I mean, a lot of us think that it's money, and we get really jacked up about making money, and we get so busy about making money, we forget why we make money for, right? I guess the age-old question, is it the time that you're after, or is it the money that you're after, right? Believe it or not, money is just a tool. It's hard to believe because we just get in the rut of making money just to make money, but money is just a tool. It just amplifies who you are as a person. If you're a giver, having money is just going to make you a big giver. If you're an idiot, money is just going to make you a rich idiot. And if you are a miser, you're just going to be the richest person in the grave, right? I mean, if that's what you're shooting for. For me, what I'm after is actually my goal is actually the free time, and money is the means to the end. So, even though all of us have the same 24 hours in a day, time is the only finite resource, right? You can make money. I mean, if you're smart, you can make money, but nobody can make time. right? So, talking about making money, it's not as hard as people make it to be for making money. There's only two principles, right? For making money, it all depends on what is the problem you're solving and how big of a problem it is, right? The bigger the problem, the more money there is, right? So that's number one. And number two is, how many people are you impacting, right? So that's why you see brain surgeons and rocket scientists make a lot of money, because they solve a bigger problem. Whereas actors and the people in TV, they actually make a lot of money because they impact a lot of people, right? So as long as you impact a lot of people or you solve a bigger problem, money will just follow. So having said that, let me just start off by talking about my why. My why was to be semi-retired at 42. When I say semi-retired, it's not like completely retired and just go play golf, every day. That's not the goal. The goal is to work when I want to work and not work at somebody else's time, right? So that was my goal. And that goal was because I wanted to spend more time with the kids, right? My first son, he's in 10th grade. He's going to be home only for 2 more years. So I wanted to spend as much time as possible with him, driving around to his golf tournaments and just being available to him. And the same with my second son. He's in 5th grade. So I just wanted to be available to him when he needs me, right? So that was the main goal. My goal is not to make money just to make money. Success without fulfillment is the ultimate failure. Just to let you know, you just don't want to be the richest person without having anything else surrounding the wealth and the life, right? So let me leave it at that. So I'll leave for you to ponder what your why is. Now let's just get on with the incomes and the taxes. So let's just talk about 3 types of income. The man at the top of the mountain didn't just fall there. This is a quote by Vince Lombardi, right? What you need to know is, you need to know there is a mountain. You need to know that it has a top. You need to know it is reachable. And you need to know some people who have reached the top, right? As Tony Robbins says, success leaves clue. You don't have to reinvent the wheel. You just have to follow the footsteps, right? Our so-called top for this webinar is saving on taxes, right? So before saving on taxes, let's just look at how the income is classified by IRS and what are the 3 types of income we have. So the first income is earned income. Most of us know earned income is just the wages. It's just being employed, right? So there is not a lot you can do. You get a W-2, you get a paycheck, and that's earned income. The second type of income is portfolio income. It's everything to do with stocks, bonds, mutual funds, ETFs, and yes, options too, right? That's also any money that you make in options. That's also comes under portfolio income. The next income is passive income. These are anything that you invest in some other business that you don't actively participate, or any rental activity. Even if you actively participate in the rental, that is still considered as passive by IRS, right? So when you talk about these incomes, you would think that, okay, so these are the different incomes. If I make money in one bucket, and if I lose money in another bucket, you can kind of offset these, right? It's not that simple according to IRS. You just need to know that these are firewalled, and these are like completely firewalled out, right? So obviously with earned income, there is no losses per se, right? You just get paycheck, and that's pretty much it. As far as portfolio income, the losses that you can have is really the actual losses. If you invest in a stock or a bond or a mutual fund or whatever, you can lose money, right? So that's the real loss that you can have in portfolio income. As far as passive income, this is kind of special. Not only you can have the real income, which you don't really want, but you can have paper loss as well, right? So paper loss is what most of the people are after. Paper loss is depreciation. It's pseudo loss. It's the phantom loss that people are after, right? So when you think about portfolio income, right? So let me just give you an example. So I just pulled up Tesla. So if I invested in Tesla on April 12th, so the Tesla stock was $762 per share. And if I bought 100 shares of Tesla, and I sold those 100 shares yesterday, and that's all I did for the stock account, I would have lost about 10 grand. I would have lost $10,000, right? And if I make, let's say if I make $200,000 on my payroll, even though the income or the money that I invested is after tax money from the payroll, I lost $10,000 in the Tesla stock that I invested in. I still cannot offset all of these $10,000 loss against the active income, right? IRS allows you to just offset $3,000 per year. I mean, you don't lose it. You get to carry forward the loss, but in this year, you can only offset $3,000, and that's pretty much it. So other $7,000, you just have to carry forward to the next year and the following year. So you just get to use $3,000 per year from the portfolio income. The next is passive income. Passive income is actually a special bucket. You can't really offset it against the earned income, right? In most cases, you can't offset it against the earned income. It's completely firewalled for most people. If you make money in the passive income bucket, if you make a real loss, you can offset it. If you make a paper loss, which is depreciation, you can offset it, which is what we'll see later in one of the slides. But for most people, it's kind of firewalled, and it's just within that bucket is how much you make. You can actually offset it, right? So this is what we have heard most of the time, right? But I'm here to tell you that there is one other strategy, right? It is the holy grail of taxes, right? So this is the golden nugget that I was talking about in the email, right? So, but before I talk about that, let me warn you that this is not applicable to most people, right? It is possible that you will be eligible, but at this time, it might not be eligible for most people, right? So that is called real estate. That's called REPS. Basically, REPS is a status given by IRS. REPS stands for real estate professional status, right? So once you get the REPS status, what that means is none of these firewalls apply. Any income, any depreciation from any bucket can just intermingle, and it can just go across, right? So that's the power of REPS. It is special. Again, it is special. Most people might not be eligible, but it's not impossible, right? If you plan, you can become eligible next year or the year after. You just have to acquire certain things, and you just have to abide by certain rules. But this is huge for a lot of people. So a lot of people jumping into real estate, this is going to be their end goal, to be eligible for REPS. So anyway, we're not here to talk about all of the details. Now that you know what REPS is, I guess you can just go in and research more about how to become eligible and all that stuff for REPS. But this webinar is just to introduce you to the concepts, what's available, right? So that's that. So we'll just talk about the next Robert Kiyosaki's 4 quadrants. So if you haven't heard about Robert Kiyosaki, you're probably living under the rock, right? I mean, he's one of the gurus in real estate. It's not really so-called like the gurus that you see in the TV. He is real for sure. He's real, right? I like his quote: "Workers work hard enough to not be fired, and owners just pay enough so workers won't quit." Right? Which is so true, right? If you're a worker, you don't work, during the weekend or, after hours or whatever, because you clock out, that's it. You're done, right? So the one that we're going to talk about is actually from Robert Kiyosaki's Cash Flow Quadrant. If you haven't heard about Cash Flow Quadrant or Rich Dad, Poor Dad, those 2 books have pushed a lot of people into real estate. And if you haven't heard about that or read that, you should really consider reading those books, especially Rich Dad, Poor Dad, and Cash Flow Quadrant. These are really good books, not just for you, for the kids, and for they have a game called Cash Flow Quadrant that I actually play with my kids. Those are really good books and good games to teach the kids about the concepts of real estate, just to introduce them to real estate and passive income. So let's just talk about 4 quadrants that he has in that book. The first quadrant is employee. This is pretty straightforward, right? I mean, employee, all of us have been employee at some point, or we are employees right now. Basically, what this is you trade your time for money, right? I mean, every hour you work, you get paid, right? I mean, for some of us, it's not really technically every hour because we get paid by, annually, and we pull in a lot of hours. But then, the concept is you get paid for the time, right? So that's the concept. The second quadrant that he talks about is self-employment. Self-employment is these are like high-paid doctors and lawyers and independent consultants and people who make quite a bit of money, but they still trade time for the money, right? I mean, they make a lot more money than employees for sure because they take more risk, but they still trade time for the money, right? So this is the left side of the quadrant, right? This is where you pay a lot of taxes, right? The goal for most of you should be to be on the right side, or be 50% or 60% or 70% on the right side. So you just want your income to start coming from the right side of the quadrant, because the left side, you will just end up paying a lot of taxes. So the first quadrant that he talks about on the right side is business owner. Business owner is you have a system and people work for you and you make money, right? So you make money because of people. You leverage people. You leverage other people's money, other people's time, which is OPM, OPT. I'm sure you must have heard about that, right? So it's not like you're working to make money. You have a system, people work, and you make money because of that leverage. The next quadrant that he talks about is investor, right? So this is where money works for you, right? This is passive. You're not like actively managing. You're not actively buying rentals, or you're not actively buying, real estate, multifamily homes or single family homes, or, whatever, right? You're not actively doing all of that stuff. You're still doing all the research. You're investing as an LP, right? Because you want the free time. You don't want all of the nonsense that goes with the investment. You just want to step back, let the pros do the work, and collect this is money making money, right? So the right side of the quadrant is where you want to be because of the taxes. And we'll actually see why in a minute. If you think about it, right, as an employee, right? I mean, let's just talk about 40%, because most of you guys in the webinar are paying a lot more than 40%. Just look at your marginal rate. It's going to be a lot more than 40%, right? Because let's just assume 40%, and we'll see why it's 40%, right? Federal tax 27%, state income tax 5%. I know in California that's not 5%. Most of you guys live in California. It's about 10%, but let's just call it average. Between Texas and California is 5%, right? There is a bunch of states in between. So let's just call it 5% as an average. And the Social Security is 6%, and Medicare, Medicaid, and all that stuff is about 1.45%. So on average, most people marginally pay at least 40 or more. The last dollar is at 40% for most people. For self-employed, this is ridiculous. I mean, if you're a high-paid lawyer, or if you're a high-paid doctor, or like a single independent consulting doctor, you're close to paying 60%, and that's just the income tax. I mean, this is ridiculous, because because you're making more money, you're already in 37% tax bracket, because the tax brackets go up, right? And for this example, let's still assume that it's a 5% tax bracket, right? The Social Security is 12%, and Medicare, Medicaid is 2%, right? This is double as an employee. The reason is you are the employee and the employer, right? So you're paying for both sides of things. So that's why it's double, and you're paying close to 60%. And that's why if you're on the left side, this is just to open your eyes that you're paying so much in taxes, right? But you actually want to be on the right side. On the right side, if you're talking about business owner, we're not here to talk about all of the expenses and the write-offs and things like that, right? Your retirement plan, all of those things. you have a bunch of benefits. There is so much tax shielding that you have as a business owner. But let's just talk about just the dividends, right? If you take the money as dividends, that's taxed at 20%. And with the tax and job cuts, I can't say that word. With that act, there is additional QBI 20% for the business owners, right? So you're not technically even paying 20% as the business owner, right? So as an investor, Robert Kiyosaki actually says that you pay 0%, right? I mean, that's up to 0%, right? I mean, you have to use advanced strategies, like you have to be reps and you have to use 1031 and things like that, right? If you use these advanced strategies, you can differ, right? You don't have to pay taxes for a very long time, right? But I'm sure, most of us are going to pay somewhere between 0 and 20, right? Even though he says 20, it's somewhere between 0 and 20, depending on how many strategies you're using and what you're using as far as strategies, right? So even Warren Buffett pays only 15% taxes, while his secretary pays more than double his tax as far as percentage. And I'm sure this was every election time that comes around, this number gets thrown out that, Warren Buffett pays half the tax percent as his secretary, right? I'm sure you must have heard about that, because Warren Buffett is on the right side and his secretary and anybody who's working for him is on the left side. And, the more left you are, you're going to pay more taxes, right? No pun intended. So now that we talked about the taxes, right? So let's see what can be done, right? I like this quote from Amelia Earhart. The most difficult thing to do is to act, right? Everything else is just mere tenacity, right? You just have to take the first step. Everything else, you just have to persist and just duke it up, right? And one other thing, this is actually from Grant Cardone. If you guys don't know Grant Cardone, he's a master marketeer. I mean, that guy is a marketing machine, and he actually is a huge multifamily investor. He says, don't trust yourself to have cash sitting around, because expenses are going to find you, right? I'm sure most of us have actually gone through that. If you have 10 grand sitting around, what do? Expenses are going to find you, right? So let's just talk about 3 scenarios. Let's say you have 100 grand. Let's just talk about, I'm sure there is multiple ways to invest, spend this 100 grand, right? For the time purposes, let's just talk about this quick 3 simple scenarios just to demonstrate, just to get the point across, right? So the first one is, let's say you have 100 grand. What do? You spend it, right? Most people are used to it, right? You spend it. Well, the reason is, what are you going to do? When you die, you're not going to take the money with you. Might as well spend it, right? YOLO. You only live once, right? I've heard that term many, many times, right? And if this is you, I'm sorry to say that you're just going to work until you die. I'm sure most of you guys in this webinar, that's not how you are. But I'm sure you must have heard about this YOLO thing, right? Anybody who's living and dying by that, they're going to work rest of their lives, either that or they're going to wait. They're just going to wait for the government or depend on their kids to subsidize their lifestyle, right? Which is pretty sad, but that's just how most people do. If they get a hike, a 10% bonus or whatever it is, first thing is, how can I renovate the house? How can I put in a new kitchen? So that's not going to bring in more money. It's just additional expenses, right? So anyway, so let me just leave it at that. And the next option, let's just talk about COVID's favorite pastime, right? I'm sure you must have heard about all of these platforms and all of those. Sorry, I forget the name of this this tool where everybody just got involved with trading. But COVID's favorite pastime is being day trading, right? Yep. So that's pretty much it. Everybody wants to day trade, right? But nothing wrong with that. I mean, that gives you the dopamine hit, right? You make money, that gives you the dopamine hit, right? I mean, I've done a lot of day trading in the past. I conveniently forgot all of my losses, and I would only remember just the winning trades, right? It's just like that one golf shot that keeps you bringing back to the golf course, right? You hit one shot, you're going to come back because you're going to remember other 99 shots that you hit, right? Just like that, right? So anyway, so if you make money in day trading, what happens is, let's assume that you make 10% average, return. Every time you make money, what happens is you actually pay taxes. And if it's a short-term trade, if it's a trade like day trade, right? If it's a trade less than a year, that is actually ordinary income. That's taxed as ordinary income, right? And if you're already at the highest tax bracket, this is actually going on top of that. This is a marginal tax, which is the last dollar. So this is going on top of all of that stuff, right? So anyway, any short-term trades is going to just push your tax even further up, right? So the next we will see is multifamily investment. But before we see multifamily investment, let me just talk about really quick a bonus tip, 1031, right? This is the ultimate no tax, right? I'm sure all of you guys have heard in US, you either pay tax now or later, right? It's like, say, for example, if it's 401k, you just defer the taxes and then you pay taxes when you withdraw. If it's Roth IRA or Roth 401k or, anything Roth, you pay taxes now. And then you let the money multiply, grow, whatever. And when you take it out, there is no taxes, right? But 1031 is such a unique thing. I'm sure all of you guys have heard about 1031, right? But I'm not sure if you guys know what the step up is and how to pass it on to the kids, right? So this, if 1031 is used properly, this is the ultimate zero tax or no tax strategy, right? Let me just give you a quick example. So let's say if you buy a single family home, this applies to any, real estate, single family, multifamily, anything, right? So because most of you guys are familiar with single family, let me just give you a quick example. So if you buy the house for 400 and you depreciate, so land can't depreciate. So if you depreciate the 300, which is the improvement, what happens is after 30 years, your cost basis becomes 100,000. Right. And let's assume that now by 30 years, that single family that you bought for 400 is like 3 million, right? I mean, I'm just picking a number, right? After 30 years, or let's just say it's $1 million, right? So if you pass that, right? So no, let me actually, step back. If you sell it, what happens is the 900,000 becomes taxable. And that's actually, you bought it for 400, you depreciate 300, right? So now the cost basis on the property is 100, right? Now the property has risen to 1 million. Now, if you sell the property, what happens is there's this gap, this 900 gap, right? So you pay capital gains tax. It's 20%. I mean, it's still good percent, but you pay capital gains tax of 20% of that 900,000, right? So let's assume that you sell the property and then you die the next day, right? I mean, this is just hypothetical, just to demonstrate the point, right? You die the next day. So you've paid the taxes on the 900, right? You've paid 20% taxes on the 900. So your kids get 900 after tax and all that stuff, right? But let's assume that you don't sell it and you pass this on to your kids, right? And the next day you die and the kids sell the day after you die, right? What happens is the cost basis, when it goes to your kids, it becomes $1 million. If the kids sell the property a day after you die, after they get it under their name, right? They sell it for $1 million. What happens is nobody pays taxes because this is called step up in basis. So when you pass it on to your heirs, they actually step up in cost basis, right? I mean, this is, we're not going to talk about a lot, but I just wanted to introduce this concept called 1031 and step up. This is the ultimate thing that a lot of people would strive for, right? So once they step up in basis and they sell the next day, nobody pays taxes. That taxes, nobody, I mean, they actually get the $1 million, but they don't pay taxes, and you don't pay taxes, and you get the depreciation. I mean, this is huge. So anyway, so let me just leave that bonus thing, bonus tip alone, but just research on 1031 and step up. We're gonna have more webinars every other week, and we'll pick a topic and we'll go in detail. But today is just to introduce you to the tax concepts that are out there. Right. So now let's just talk about this multifamily investment. Let's assume that you invested multifamily. Let's just run through one of the quick scenarios. And this scenario that we see here, so this was presented by Mike. This is actually one of the deals that was presented last, was it the week before when we did the webinar, right? So let's assume that you invested $100,000. Let's just keep it, round numbers, right? Let's assume that you invested $100,000. Typically what happens is when you invest $100,000, you get a depreciation. You get a lot of depreciation, but for this example, let's just keep it simple. You invest $100,000 in Jan 1 this year, right? Let's say you invest in Pecos Capital. We would give you 80,000 or 70,000, right? Let's just call it 80,000 just for this webinar's sake. You invest 100, we'll give you $80,000 depreciation, right? You can't technically use it yet, but we give you $80,000 depreciation. So what happens is you get that 80, you keep that 80,000. This is that passive income bucket that we talked about, right? This is the paper loss that we talked about. So you get that 80,000, you keep it. Every year, on the first year, let's say you get this 7,461, right? You don't pay taxes. This 7,461 will be offset by this 80 grand that you got in depreciation in year 1. The second year, you got 6,000. Again, you don't pay taxes. It's offset by the 80 grand. The third year, you don't pay taxes. The fourth year is 7 grand. Fifth year is 7 grand again, right? You don't pay taxes because these cash flow, these dividends that you get will offset all of the depreciation, right? At the end of year 5, let's assume that we sell this at end of year 5. So you would have got about 36,116 in just the cash flow, right? So you don't pay taxes at all for this investment that you made for 100 grand. You don't pay taxes at all, right? So that 36,000 will be offset. And then on top of that, when we sell the building, because I'm sure you must have known about the value, forcing the value and forcing the appreciation and all those things that we talked about in the last webinar, we would get, let's say that we sell the building for a $55,000 profit, right? So technically you would get this 36,000 and this 55,000 at the end of year 5, right? So it's not tax-free. This is not like 1031 and step up and all that stuff. You still have to pay taxes, right? This is not tax evasion. I want to be clear. This is not tax evasion. This is tax deferral, right? The tax efficiency doesn't mean cheating or doesn't mean evading taxes. You just have to figure out a way, understand what are the rules and work within the rules, right? Just work the system, just work within the rules and defer the taxes as much as you can, right? So this 36,000, again, the average annual return is about 18%, right? If you had the same return in stocks, what would have happened is this 7,000 would have been taxed at 40%. This 6,000 would have been taxed in year 2 at 40% again, right? So that's the huge thing, right? Versus in multifamily, you don't pay taxes until 5th year. And even in 5th year, what happens is, when we sell and when we close the books and all that stuff, you have to, I guess you remember that we gave the 80,000 depreciation at the beginning of the year. It has to be recaptured. That's called depreciation recapture, right? You haven't really used all of the 80,000 unless you're a reps, of course, right? But let's assume that you're not reps and you're having a high paid income, which is what this webinar is about, right? We gave you 80 grand. you're only, after the 5th year, you've only used, let's just say argument's sake, 40 grand, right? Or 35 grand. You've only used 35 grand. The other 45 grand you've not really used. So that just washes out. And this 35 grand, you have to recapture all of those income. I mean, all of those depreciation. The good thing in depreciation recapture, this is actually a big term for you guys to just think about and research, right? Depreciation recapture. The good thing in depreciation recapture is it's capped at 25%, right? It's capped at 25%. If you are at 40% income, you're not going to pay 40% even at the end of year 5, right? You've not paid taxes at the, until the 5th year. Even at the end of year 5, this is capped at 25%, right? And what about this 55 grand? This is capital appreciation. This is capped at 20%, right? Of course, there are talks that capital gains are going to be gone, and 1031 is going to be gone, and all of these things. But forget about all of those. Those are just talks. At this time, capital gain taxes is 20%, and depreciation recapture is 25%. Right? So that is what you would pay after the end of year 5. So this is what I really wanted to just show and demonstrate, that this is possible, right? So just because it is somebody else's reality that they're paying 40% taxes, that doesn't have to be your reality, right? You can create your own reality. We are living in knowledge-based economy. You just have to know what's out there, what options are there, and you just have to work within the system. Understand the system, work within the system, right? So my goal today was really just to open your eyes to just what options are out there, right? So you can actually have intelligent conversation with your CPA. Again, this webinar was really to just open your eyes. We're not here to give any tax advice or whatever. This is just for educational purposes. This is just to introduce you to new concepts. And if you have any questions, please talk to your CPA. And that is the end of it. And if you guys have any questions, bring it up in the chat box, please. And these are our contacts. If you guys have any questions, please let us know. Mike, if you have any questions.
Yeah. Thank you, Malai. That was great. It's you can definitely tell you're very passionate about this. And I think the most powerful thing is really just, as you said, it's not evasion, it's deferment, right? So you get an income stream for 5 years, but you get so much year 1 depreciation loss that those 5 years of income, you don't actually pay until the end. And then you're capped at the 25, as you mentioned, the 25% for depreciation recapture. So definitely very powerful there. And then of course, on the sale, any gain on the sale is subject to capital gains. As everyone knows, it's a big topic today with Biden and how that's going to change. But definitely very informative. Thank you, Malai, for that. And so we did have one question. Suva asked, can that depreciation be used against other passive gains? So I'm assuming he's talking about if you're in that passive gain income bucket, can that depreciation be used to offset other passive gains, not from that specific project?
So that's an excellent question. So what happens is, it's not, so there's only 3 types of income. If you guys see here, either it's earned income, portfolio income, or passive income. So if you have invested, let's say for example, you invested in your friend's Subway and they give you a K1 and you're passive, right? As long as it's passive, you're passive. Any passive will apply, even if you're not reps, this bucket. So if you get depreciation, any income, it doesn't have to be real estate income. Any passive income can be used. So if you invest 100 grand with one of our deals and we give you 80 grand, what happens is that can be used with any other passive income as well. It might get a little tricky when you talk about depreciation recapture, but yes, it can be used.
Gotcha. That's good to know. Yeah, I mean, like you mentioned, it's there's a lot of power in the depreciation that you can gain from real estate investments. I know a lot of people use it if they're reps, like you mentioned, they use it to offset a ton of other income. So a lot of strategies out there. Definitely consult your CPA if they're not a specialist in real estate tax, and you're very interested in investing in multifamily properties. Definitely consult a real estate tax professional, because they can help make it, go from efficient to super efficient. So always getting with your professional is a great way to go, and they can help you save the most tax and be the most efficient as possible. So I think that's all the questions that we had today. So once again, thank you everyone for joining. It was great to have you here on the Friday night. We will have another presentation, as Malai mentioned, in a couple weeks. It'll be about single family homes versus multifamily home investments. So we'll give a couple case studies and walk you through that. And it's going to be a great show. So definitely be sure to tune in for that. And until then, we'll see you next time.
Thank you, guys. And we went a little over time. I'm sorry. I get passionate and I start talking about this taxes and creative finance. I just go over time. So pardon me. And we will actually, once we are done with editing, we'll actually put this also in YouTube and Facebook and LinkedIn, and also in our website. So if you guys have any questions, just look up our Knowledge Garden. Our goal is to educate, have educated investors. If you guys have any questions, let us know. This is you guys have our contacts. Thank you, guys. Appreciate it.
Yes, thank you, everyone. Have a good evening.
Malai. Thank you.
Bye.